So, as you all know, UAE has two zones, like one is the free zone and one is the mainland. So today our topic is mainly related to the designated zones, which is there in the free zones. Okay. So if I'm talking about the free zone means it's like a special economic zone. They have some special rate or concessions when it comes to the customs duty or any other charges. And most of the companies like which is into import and export, they are the ones who go and register the company in free zone. And there are some other free zones where there is no port as such, but then due to the cost of the license, some people are starting the business in the free zones. So due to all these reasons, FTA for FTA, like they have published a list of designated zones. That means free zone itself. FTA has mentioned, okay, these free zones are designated zones as well when it comes to the VAT. Okay, so as I told, because there are many free zones now opened in UAE where they doesn't have a port. They just open a free zone and people can take the license. The license cost will be less, but then when it comes to the import and export, they have to approach any other free zones. Okay, so due to all these reasons, like we have FTA have published a designated zone list. So when it comes to designated zone, there are some criteria or some qualifications which they have to go through to consider it as a designated zone. Okay, so today we are going to talk about the designated zones. So I'll be covering what is a designated zone, what are the criteria to qualify as a designated zone, then the VAT registration and status of the businesses which is in there in the designated zone, VAT treatment of services, VAT treatment of goods, because both of them have different treatments. So that's the reason we have two separate topics. Transfers into, within, and from designated zones, import VAT rules, then special cases. When it comes to water, energy, and real estate, there are special cases for VAT, how it is treated, even though if it's in a designated zone. Then VAT groups and branch rules and VAT recovery in the designated zone. So as I mentioned, a designated zones, like the fundamental principle is that VAT applies to supplies within the UAE. So VAT is applicable to all the companies that is there in the UAE. When it comes to the VAT, there is no differentiation, like designated zone is not treated as outside UAE. It's inside UAE only. But when it comes to goods, yes, there is some special treatment. Otherwise, VAT applies to all supplies within the UAE. And not all free zones are designated zones. As I mentioned before, there are a lot of free zones in UAE, but all the free zones are not designated zones. Only the free zones listed in the cabinet decision qualify. So there is an FTA published list for the designated zones. After this session, I will share the list so that you can go through it whenever you get a client or you get a company. You can check whether the company is a free zone or not, and even if it's a free zone, whether it's a designated zone or not. And designated zones are treated as outside UAE for VAT only for certain supplies of goods. Services in designated zones are always treated as supplies in the UAE. So for the goods, if it's done between the designated zones, it's considered as out of scope, like outside UAE, so it will be out of scope. But when it comes to services, services are always charged at 5%. There is no special treatment for services, even if the services are happening inside the designated zone. So please note this point. Whenever you get a company who is into services, they are not dealing with the goods, then all their transactions will be charged at 5%. Then what makes designated zone different? So designated zones are treated as outside the UAE for VAT purposes, but only for certain supplies of goods. And this create unique opportunities and obligations for businesses operating in this area. So they are getting some special considerations. So companies who are dealing with the goods, if they start in the designated zone, yes, they are getting some special considerations. So here the main point to notice, Services supplied in a designated zones are always treated as supplied within the UAE and subject to the standard VAT rules, means the standard like 5%. Now let's see why designated zones were established. So main point is to facilitate the international trade and control the movement of goods and prevent VAT avoidance. So if they are in a designated zone, they get a special consideration when it comes to VAT. Then it's easy for them to, for the movement of the goods. Then facilitate international trade, enable businesses to trade goods on a VAT neutral basis. So these are the main points why designated zones were established, or why free zones were established. Now, who needs to understand the designated zone rules? Mainly the tax managers and accountants who have a company inside the free zone, and if it's a designated zone, yes, for them. And businesses operating in the designated zone, the logistics and warehouse managers, decision makers, and the finance team. So these are the main people who should understand about what a designated zone and what are the rules when it comes to the VAT. Now let's see the qualification criteria. A free zone is only treated as a designated zone if all the conditions mentioned below are met. So first condition is that defined geographical area. So it must be a specific fenced geographic location with clear physical boundaries that separate it from other areas. So in short, a free zone to be treated as a designated zone, it should be covered with fence, and there should be a customs entry and exit. Uh, Whenever like a person has to go inside, they should have to get a pass from the customs or from the authority. So if a free zone has a fenced area, then it can be treated as a designated zone subject to other conditions as well. So the first point is define geographic area. Second one is security measures. Comprehensive security systems to actively monitor and control the movement of individuals and goods in and out. So I don't know whether how many of them have been into the free zones. If you go to a free zone, and if it's a, as I mentioned, if it's a free zone with a fenced area, then you will see that whenever we enter and exit the free zone, if we are going in a vehicle, they will, for sure, we have to go in a vehicle only. So they will check our car. If it's a car, they will ask to open and show like all the seats and the entire car, they will check to make sure that we are not carrying any goods from the inside the free zone, like because people used to do this just to avoid a customs duty. So they will just take some samples or some items in the car and just leave through the customs. So in order to avoid that, this they will make sure that there will be a security system, and they will make sure that nothing is carried in the inside the vehicle. Customs control full customs procedures and checkpoints for all goods entering or exiting the designated zone. So same with when we take some goods inside the designated zone, same rule applies. If we are taking something, we should have the proper documents, customs document, and there should be customs duty paid for that goods. Otherwise, we cannot just carry some goods inside the free zone. Internal procedures, documented system for storage, process, and tracking of goods while inside the free zone, and FTA compliance. So meet all additional requirements set by the FTA. So these are the qualifications for a free zone to be considered as a designated zone. Now, partial qualification and compliance. So you will see that some free zones, they qualify partially, but not fully. So not all sections may qualify. Within a single free zone, some areas may meet all five criteria, while others do not. So only the qualifying sections receive the treatment as being outside the UAE for VAT purpose. And each section must be evaluated independently against the criteria. And physical separations, security measures, and customs control must be maintained for each qualifying area. So you will see some free zones, they have some conditions, they are meeting some conditions, but again, if there is no proper security and fenced system, and then that cannot be treated as a designated zone. So loss of designated zone status. So if a designated zone stops meeting the qualification requirements, it immediately loses the special status. The area will then be treated as mainland UAE for all VAT purposes going forward. Now let's see the VAT status of the businesses in designated zone. So treat it as an onshore for VAT. So despite being physically located in a designated zone, businesses are considered onshore UAE entities for all VAT compliance purpose, and the designated zone location does not exempt them from standard VAT obligation. So as I mentioned, VAT is applicable for all the entire UAE. And when it comes to the designated zone and when it comes to the goods only, there are special treatment for goods. It's considered as outside the UAE. Otherwise, it applies to the VAT applies to the entire UAE. And full VAT registration required. So they must register for the VAT when turnover exceeds. As you all know that mandatory registration threshold for the VAT for getting the VAT registration is 187,500. Sorry, voluntary limit is 187,500 and mandatory is 375,000. So if a company is exceeding those thresholds, they can go ahead with the registrations. So some people think that, okay, since I'm registered in a designated, I have my license is from a designated zone, I don't have to go for the registration because I'm getting special concession from the FTA. No, it's not like that. Once you cross the threshold, you have to mandatory go for the registration. And then some cases, like for example, if the company is doing only exports, they can apply for the registration and get the exemption from the FTA. Then the standard filing obligations. So same like once they get the VAT registration, they have to follow the filing process. They have to quarterly or monthly, according to the VAT certificate dates, they have to do the filing. Then the VAT group eligibility. Designated zones can join the VAT groups if they meet the standard criteria, including the 50%. So if a company has a 50% shareholding in another company, so these two companies can form a group. So even the second company is in designated zone, they can form a group. Now, let's see VAT treatment of services in designated zone. So as I mentioned before, services are always taxable. All services supplied within a designated zone are treated as supply in the UAE, regardless of where the service is performed or consumed. So whatever service a company provide within the free zone, within the designated zone, 5% VAT will be applied. So standard rated 5% in most cases and zero rated only in normal export. So if you're providing a service from within the mainland to outside UAE, it will be considered as export. So same treatment applies to designated zone as well. So whatever services provided within the designated zones or designated zone to mainland will be considered as 5%. And whatever services provided from within the designated zones to outside the UAE will be considered as exports. So 0% will be the VAT rate. So same treatment, what we does in the mainland applies to the designated zones when it comes to services. Then exempt services follow standard exemption rules. So other VAT rules apply same in designated zones when it comes to services. Unlike goods, there is no special treatment for services in designated zone, and service providers must apply for VAT according to the standard rules. Now let's see the VAT treatment of goods. So the default rule is goods remain in qualifying designated zone when goods are supplied and stay within a qualifying designated zone. Treated as outside the UAE. So supply of goods is treated as outside the UAE for VAT purpose and outside the scope of VAT. So no UAE VAT applies to the transaction. So it's totally considered as a outer scope transactions when it comes to goods. But then again, there are some conditions for the goods to be treated as outside scope. Let's see that in the later slides. And this default treatment creates a VAT neutral environment for trading and storing goods within the designated zone, facilitating international commerce without immediate VAT impact. So before, like in the previous slides, we have seen that, okay, why these free zones or designated zones are implemented. So same thing, like here also it's mentioned that goods are treated as 5% in order to facilitate the international commerce. Now comes the consumption rule. So in the previous slide, we saw that goods are treated as outside scope or outside the UAE, but then there are some conditions. If they are not fulfilling these conditions, then it will be treated as 5%. So let's see what are the like exemptions, like or how the rule override. So when VAT becomes payable, let's see that even within a designated zone, goods become subject to UAE VAT if they're consumed by the purchaser or any other person. So 0% or not 0%, out of scope applies only if the designated zones, if the seller is selling to the buyer and the buyer is buying for that for the resale purpose, not for his consumption. So let's say if the buyer is buying that for the his consumption, then on those sales, 5% need to be collected by the supplier. So in short, if the buyer is buying it for the consumption, then it will be considered as a normal 5% transaction. So consumption includes use of the goods, application of the goods, and exploitation of the goods. Then there are some exemption like resale. For example, if a company is buying that goods for resale, then that does not equal to consumption. That is not considered as a consumption because he is buying that for resale. He is not going to use that or consume that for his personal or a company purpose. So buying goods for resale purpose keeps them outside the scope of VAT, even if held in the designated zone. So the point you have to check is whether the buyer is buying it for resale or for consumption. If it's consumption, then you should check the supplier invoice whether they have collected 5% VAT or not. Then the exemption to the consumption rule. Goods remain outside the scope of VAT even when used if they meet the specific manufacturing criteria. So let's see some areas where it will be considered as outside the scope, even if it comes under the consumption. So incorporated into another goods. Raw materials or components physically become part of a finished product manufactured in the same designated zone. So let's say a buyer is buying that to produce something else. So even though it's a consumption, part of consumption, but he is using that goods to make some other goods, which he is gonna resell it. So in this case, it will be treated as outside the scope of VAT. Used directly in the manufacturing. Like for example, if you're buying tools, equipments or materials, which will be directly used in the production process of manufacturing another goods within the designated zone, then again, this will be treated as outside the scope of VAT. So direct use requirement, the connection to manufacturing must be direct. Indirect or administrative uses do not qualify for this exemption. Let's see some examples of goods within the designated zone. Outside the scope of VAT, for example, like trading stock purchased for resale. So held in a warehouse waiting customers order. So if I bought some goods and I have kept in the warehouse and I'm waiting for the customer's order. So these are all outside the scope of VAT because I'm going to resell it. So it will not come under the 5% category. It's totally out of scope of VAT. Steels used to manufacture machinery directly incorporated into final product. So again, I'm buying some steel products for manufacturing some other products. So again, it will be treated as outside scope of VAT. Tools used directly in the production, raw materials used for manufacturing. So all these come under the outside scope of VAT. Now let's see what items come under within the scope of VAT. Some examples are office equipment and furniture. So if I have a company inside free zone, that too a designated zone, and I am buying some furniture or equipment for my office, that will be used for my that will be bought for my consumption. So that with that furniture, I'm not going to make any other product for resale. So those things, 5% VAT applies. Then company vehicles and fuel, food stationery supplies, other supplies, computer for design purpose. So let's say my company is in designated zone and I'm a manufacturer. So before manufacturing, I have to do some designs for the product. So for that purpose, I bought some computers or laptops, whatever it is. But then again, this laptops or computers cannot be considered as outside scope of VAT because even though it indirectly uh, comes into the manufacturing of goods, there is no direct relationship. So only those items which have a direct relationship can be considered as outside the scope of VAT. Then goods for private use. So any personal consumption. So some items which I bought, which will be consumed personally, then those items will not come under the outside scope of VAT. Now, this is just for you to understand, used in manufacturing. So if it's a direct, there is a direct relationship, then it will be outside the scope of VAT. You should check whether goods are consumed. If it's consumed, whether it's for the personal purpose or for the manufacturing. Then when it comes to services, always apply standard UAE VAT rate, which is 5%. And is it goods or services? So identify the supply type. Initially, when you get an invoice or when you get an order, you should identify whether it's a supply or a supply of services or supply of goods. So if it's supply of services, straight away you can apply for 5%. If it's supply of goods, you have to see whether it will be consumed for personal use or whether it will be consumed for manufacturing purpose, and whether there is a direct relationship or indirect relationship. So these things you should understand first before you come to a conclusion that it's coming outside the scope of VAT. Now let's see transfer of goods into a designated zone. So first one is from outside UAE to designated zone. So it's always out of scope of VAT. So goods imported directly from international sources into the designated zone are not subject to UAE VAT at the time of entry, provided they remain in the designated zone. So any imports done within a designated zone, it's considered as outside the scope of VAT. But if that import, again, if that import is done for the personal consumption or not for resale purpose, then it will come under the 5% category. Then we have to do that RCM and file the return. Now let's see when goods move from mainland UAE to the designated zone. So that is treated as local supply and VAT applies. So a mainland company, if they are selling some products or items or services to the designated zone, anyway, mainland, they have to charge 5% because they are registered for VAT and they don't have any special considerations. So whenever mainland companies sell to designated zone, 5% will apply. Then now we will see the transactions between the designated zones. So that is outside the scope if conditions met. Transfer between the designated zone is outside the VAT scope if goods are not used, consumed, or altered during the transfer. So if these things doesn't happen, then it's again outside the scope of VAT, and custom suspension rules are properly followed. And FTA may require financial guarantee. So there are situations where FTA asks for the financial guarantee in way of like check or some financial guarantee they will ask for. So what happens is if a company between the designated zones, if they are transferring the goods, FTA will ask for the check amount for that VAT value. So that's what I mentioned here is FTA may require financial guarantee. And once the goods reach the destination, they will release that. Now let's see import from designated zones to mainland UAE. So movement triggers import VAT. So when goods move from designated zones into a mainland UAE, this is treated as an import of goods for VAT purpose. So that is like a normal rule. Like if a mainland company is buying from outside, the same treatment applies to the designated zone as well. And VAT, import VAT becomes payable at 5%, charged on the value of goods at importation and subject to customs clearance procedures. But the point here to note is the company who is sending the goods from the designated zones to the mainland doesn't have to charge VAT, but the person who is buying from mainland, because this will be the company who will be clearing the goods, so they will have to pay 5% VAT at the customs if they are not registered for VAT. If they have registered for VAT, the normal rule applies. So it will come under the RCM. They have to declare, they have to clear the goods using their TRN number and declare it as RCM when they file the return. Recovery of previously paid VAT. If a VAT was already paid on the goods while they were inside the designated zone, the importer can recover this VAT in full when bringing the goods to the mainland. And proper documents and records are essential. So this is a VAT treatment summary metrics. If you see outside UAE to designated zone, it's actually out of scope, you can say, or 0%. Designated to designated zone, again, it's out of scope. Designated zones outside UAE, again, it's treated as outside scope only. There is no export in that. Mainland to designated zone. But when it comes to the services, it will be treated as 0% export if it's from designated zones to outside UAE. Now, mainland to designated zone, we have seen that 5% will be applied. So it will go as a cost for the designated zone company. And again, they can recover it when they file the return if they are VAT registered. Now, designated zones to mainland, there will be no VAT charged by the designated zone company, but mainland company have to charge 5% VAT. Consumption or loss of goods. So, owner consumption. When goods stored in a designated zone are consumed by the owner, not for resale or manufacturing, they are treated as import into the UAE at the time of consumption. And if VAT was not properly paid, import VAT becomes due. So this also we discussed before. Like if I'm importing some goods and I'm in a designated zone and I'm using that good for my personal purpose, then import VAT applies. So in this case, it will not be considered as outside the scope of VAT. Then goods become unaccounted for if goods cannot be accounted for or located or documented properly within the designated zone. So when FTA comes for a verification or something, if you are not able to provide them the proper documents to prove that these goods were imported for resale, then again, this will be considered as 5% chargeable. So here the point to note is documentation is critical. So that's how we can prove them that these goods were imported for resale purpose, and we can take that outside the scope of VAT exemption from the FTA. Then there are some special rules for water and energy. So they are always subject to VAT. Water and energy supplies are classified as goods. They are not treated as services. They are considered as goods under the VAT law, but they receive special treatment in designated zone. So when consumed within a designated zone, VAT always applies at 5%. So you might have seen some invoices for the companies which are in designated zone, like for example, Deva bills or HSLAT or Do bills. They will be charging 5% VAT, because even though those companies or the Deva providers inside the designated zone, the 5% VAT applies to them. So this rule applies even if used in manufacturing as well. So if you are going to justify saying that this electricity was used or consumed for making some other product, which is there for resale, even in that case, this will be treated as 5% only. So there is no exemption for water and energy, which is used inside the designated zone. So no exception for direct use in production. And business must budget for the VAT on utility cost as part of their operational expenses in designated zone. Because since they cannot recover it, they will be a 5% VAT on that. So then they have to budget accordingly. Then when it comes to real estate, so real estate is also classified as goods for the VAT purpose. And sale or lease of real estate in a designated zone is considered as outside scope of VAT. And any other things like related services such as license rights or hotel accommodation. So if there is a hotel inside the designated zone, 5% VAT will be charged from the person who is using that. Otherwise, any sale or lease happens inside the designated zone, it's outside the scope of VAT. Why? Because real estate is considered as goods. If it was considered as services, again 5% will apply. But here, real estate, water, energy, those items are considered as goods. VAT groups and designated zones. So business operating in designated zones can integrate into the broader UAE VAT framework through VAT grouping. So however, specific rules applies to the movement of goods. Now let's see designated zones, companies in VAT groups. Entities located within the designated zones can form or join a VAT group, provided they meet the standard conditions for VAT grouping. So there are some conditions for the VAT grouping. So if they meet all the conditions, then they can form the VAT group. Intergroup supplies. So supplies of goods and services made between the members of the same VAT groups are generally disregarded. I hope you are aware of the tax groups conditions, and the advantages or the benefits available for them. So if we are forming a group, VAT group, whatever transactions happen between the VAT group, they can just raise the invoice without charging 5% VAT, because that is also treated as outside scope of VAT. So let's say a company A, B, and C forms a group. Whatever transactions happens between this A, B, and C, like interrelated transactions, they don't have to raise a tax invoice as such. They can raise an invoice and it's anyway outside the scope of VAT. Designated zone to mainland exception. Crucially, the physical movement of goods from a designated zone to mainland by a VAT group member is still treated as an import and triggers the import VAT regardless of the grouping. So when it comes to the import of the goods, even though if it's within the same group, but that import rule, VAT rules apply. So that 5% either they will have to pay, since they are coming under the group, they don't have to pay. They can use the TR and clear it and declare it as an RCM. Now let's see branch rules in designated zones. So dual branch operations. So companies are permitted to establish and operate branches in both designated zone and mainland, facilitating diverse business strategies. Interbranch transactions. So similar to intergroup supplies, internal transactions between a company's designated zone branch and mainland branch are typically disregarded for VAT purpose. So these are all for like to simplify the internal accounting process, to reduce the administrative work. So if there is a branch in free zone and in a mainland, transaction between them are disregarded. Designated zone to mainland goods movement. So despite the disregarded status for transactions, any physical movement of goods from a designated zone branch to a mainland branch is treated as an import and remains subject to VAT, import VAT. Now, VAT recovery in the designated zones. So we have seen the conditions for the free zone to be considered as designated zone. Now let's see the VAT recovery rules. So standard input VAT rules, normal input tax rules applies to the business operating within the designated zone, ensuring consistency with the broader VAT regulation. So if a company inside the designated zone is registered for VAT, they can claim the input VAT. There is no restriction on that. So same rule outside the designated zone, same rule applies to the designated zone as well. Full recovery for taxable supplies. So if a designated zone business exclusively makes taxable supplies, full recovery of input tax is available, simplifying the compliance. And no recovery for exempt supplies. So that is the same rule for mainland as well. If you are doing an exempt supplies, then the VAT, which the cost which you have incurred for that exempt supplies will not be recoverable. So same rule apply for the designated zone as well. Input VAT cannot be recovered for expenses related to making exempt supplies, aligning with the general VAT principles. So this is the same rule for mainland and designated zone. If you are into like sale of bare land, something like that, then it comes under the exempt category. Then VAT cannot be recovered. And apportionment for mixed use expenses. For expenses used for both taxable and exempt supplies, input VAT must be apportioned based on the ratio of taxable to the exempt supplies. So if a company has both exempt and the taxable supplies, then they have to take on a proportionate basis. They cannot claim the entire input VAT. They have to take on a proportionate basis. Now, key takeaways are like designated zones are not fully VAT-free zones. There are some conditions for them to satisfy. So special treatment applies only to specific supply of goods, and that too they should meet some specific criteria. And services and consumed goods remain taxable. That is 5% tax will apply to services and consumed goods within the designated zone. Services always taxable in the UAE. All services supplied in the designated zone are treated as supplies in the UAE and subject to standard 5% rate. Goods taxable if consumed. So consumption rule override the default treatment. The default treatment is that goods supplied within a designated zone is outside the scope of VAT. But then consumption rule overrides that. So businesses must carefully track how goods are used. If they are consumed, then straight away 5% applies. Import rules still applies. Like if we are moving goods from designated zone to mainland, there is no extra exemption for that, even if it's a designated zone. that import rules apply. So when they import, 5% VAT has to be paid at the customs by the buyer, and they can take the RCM. So either they have to pay or they have to use a TR number and then clear the goods and then claim the RCM. Documentations and controls are essential. So robust record keeping, customs procedures and compliance systems are mandatory to maintain designated zone status and support VAT position. So whenever there will be a FTA verification, you'll be able to prove that you are in a designated zone and you are doing supply of goods. So that's the reason, and that too, it's not consumed. So that's the reason you're not charging any VAT. Then it will be considered as a outer scope or outside the UAE. So yeah, so that's it from my end. Now let's start the question answer session.